Hi, Victor.
Hello, welcome to the fifth installment of the Daily Market Web for December 15th, 2020. Today was a very exciting day. How exciting was it for you?
Actually, I was going to say the exact opposite, that it wasn't really exciting at all. It was a 20-point range roughly on S&P 500. It failed to make all new time highs. NASDAQ did, but S&P 500 didn't. And I thought that the Fed meeting was completely unexciting and uneventful. At least I haven't learned anything new from them. They keep buying bonds, and the only thing that I did learn from them, I thought it was funny. They think that they can help us fix the global warming issue. Powell said that climate change is relevant to our existing mandates because they have to regulate the banks, and climate change is an emerging risk to financial institutions and the economy. What are your thoughts?
Well, he's a real trader, a real chameleon. That's the regulatory idea of the SEC and the CFTC and the woke people. It's part of the Green New Deal, and it would be very bad for the market. Wall Street Journal said it would be great for Bloomberg, and other billionaires, but very bad for the others. It's bad enough that some companies are concerned about issues such as diversity, and now they're going to be concerned about the environment. And a company is supposed to make profits, and supposed to give capital to the companies that are able to deploy it profitably, and that's how the economy works. And whenever you put another idea and another goal, it takes away from what the primary purpose of corporations is. My wife is a very big fan of conscious capitalism, and that's certainly a distraction from the main purpose of companies, but it's probably good for profits, so let it be. Now, I noticed that, speaking about, to me, every day is wild, but from 3:30 in the morning to 6 to 5 o'clock at night, Eastern time, the half-hour prices were within 2 points of each other. The high was 37.01, and the low was 36.90. So there was an 11-point range. But yet, there was a lot happening. As you say, the market went to a new high. It broke the round number. Then it failed. Gold was up $12. Bitcoin set a new high of 21,000. So bonds were pretty much unchanged.
Right.
Here, how do I get the
And there is more chatter on stimulus continuously. So maybe after it passes, the market will move one way or the other a bit more. Although I think it will be anticlimactic and the market probably will sell off on stimulus.
What chart do you want here?
Yeah, it's not that.
Just
Well, what were the relevant things that were happening to you? What made the market move today?
Yeah, I don't think anything really was that exciting in the market today. It was just basically, like I said, a narrow range. I feel like the market is already in a holiday mode and not much is happening. Although this Friday is rebalancing and the options expiration and Tesla inclusion into S&P 500. So there is lots that could happen, plus the stimulus. So maybe tomorrow or Friday will be more interesting for me, at least. Today was just not much happening.
Well, the infrastructure loves a day like this because
Right.
basically they can take the other side of every 2 or 3 point move. It ends basically unchanged from the open. So all the people who got extended by buying when it went up 4 or 5 points and selling when it went down 4 or 5 points lost
Right.
money. And that's the way it usually is. The market has a tendency to have an equilibrium with the open. Very rarely does it have a large closing very far from the open. But of course, it's been 5 days now since the market set a new high. And it's very important. Let's look to see what happens when it's been 5 days from a new high. And put that in. David, do you know that?
Yeah. As of what?
As of the close, yes.
It also would be interesting to backtest, if you can, if market closes positive during FOMC, what's the next day's reaction? Is it negative? Is it?
Well, that's what I test every day. And it's been a long time since the new high. I think we're going to set one. The market dropped about 6 points from 330. It was at a new high as of 330, and it closed down 6. You have that, David?
Yeah.
David, you have to do it on survival. What else was happening today?
Well, while we're trying to figure this out, there was an interesting development in the health area. For example, American Medical Association has finally and quietly changed its standing on HCQ prevention order. Hydroxychloroquine, it finally gave permission to physicians to prescribe it, even though it before blocked it. So now that thousands of lives lost unnecessarily, AMA finally changed its stance. again, vindicating Trump and again, doing it too late after the election. And another study came out that was very interesting to me, showing that aspirin was associated with about half the risk of mechanical ventilation, ICU admission, and death from COVID. COVID is associated with hypercoagulability, and thrombotic risk is very much increased in chronic ill patients. So aspirin seems to be another cheap drug that we're not looking at as a preventative measure for COVID.
Well, there have been 9 times in 2020 when the market has gone 5 days, exactly 5 days, without setting a 20-day high.
Mm-hmm.
And on average, it takes 13 days for the next new high. And when the market does set a new high, it's 23 points higher. However, the expectation after 5 days without a new high is normal. So it's not bullish or bearish. However, the fact that the market dropped, it tried to set a new high and then it failed.
Right.
It will probably try to set a new high overnight. The fact that gold was up $12, that's very bullish on the Fed move. So I'd say that everything's looking very good. The Nasdaq set a new high. I noticed that the Wall Street Journal had an article about the new quantitative approach to football signals, football moves. They find everybody is following the Pittsburgh approach, which is very quantitative.
Personnel moves.
No, it's based upon using the Oakland approach to baseball substitutions, and they're now using that in football. And one of the main results is that teams should be much more aggressive. And there's been a change in the way teams apply it. It used to be that on a fourth and yardage to go, like 4th and 1, when it was 4th down, and they needed yardage to make the first down. 11% of the time, they actually went for the yardage rather than punting. But now it's up to 20%. So the teams are using the same type of quantitative analysis that we use in the stock market, and that so many so many quants are using seems to be working.
Interesting.
I notice also that reading the papers in New York, the 21 Club, which is the oldest continuous club, continuous restaurant in New York, is closing down. They can't make a profit
Right.
when they're locked down.
Yeah, it's
And,
hard.
and all the restaurateurs are protesting, having marches, because there's no indoor dining allowed in New York.
Yes, many of them are moving to Florida, where our governor said that he has no intention to shut down the restaurants again, because he understands that it's business for many people that which cannot survive being closed.
You said that real estate prices in Florida are relatively low.
Compared to New York, for sure.
How is it in Palm Beach where you live?
It really depends a lot on the location and proximity to the ocean. The closer to the ocean, the higher the prices. The farther away, the cheaper the price. But it's probably 10 times cheaper than New York City.
Do you think that the stimulus bill will finally be passed?
Yeah, I think so. I think it will finally pass. They almost compromised and reached an agreement. I think it's minor details left for now, and I think the market probably will sell off on the news because it's been priced in, and it's not going to be as large as the market wants.
What other factors are affecting the market today?
Well, actually, I was going to ask you, what do you think about Tesla and its potential inclusion into S&P 500? It seems like it's, in Tesla in general, it seems to be a very controversial stock. People either love Elon Musk and think he's the messiah to save the planet, or they really hate him, think that he's just a fraud. Which side are you on?
I'm on the former side. There was a nice article about academics have studied the effect of large short selling on the future prices of companies. And Jay Ritter, who's a professor in your neighborhood at Miami, is the leading expert on the performance of companies based upon the percentage of short sales. Now,
Right.
he's short Tesla, and that's a very bad thing to be. Also, his studies show that new issues perform much worse than the market. So I hope he's not short the new issues, which are up 100. The average new issue has been up 110%
Right.
this year.
Right.
And whenever there's pessimism, the new issues perform very well. And an index of new issues in the last 5 years has probably gained twice as much as the market. Of course, in order to get it, as we said, you have to pay your dues, because you have to be a good customer, and even the big institutions can't get a full allocation of the stocks that they want. As for Tesla, there are studies that show that the performance of companies when they're on the day that they're included in the index. And as I said, the main results of those studies are that the companies that are taken away when they include one do much better than the companies that are included. So I would say that I don't expect a big jump in Tesla when it's added to the index. However, eventually the fact that every other car manufacturer is competing with Tesla and with their own electric vehicles, that will have to have a negative effect. You know, the problem with shorting is that in addition to the fact that you're going against the 60,000-fold a century move in the stock market, is that you have to pay money when you borrow shares. So
Right.
if you want to sell Tesla, you probably have to pay like 5% a year. It's bad enough that if they were ever to declare a dividend, you'd have to pay the dividend. But
Right. And you also take the risk that your shares being called away from you in the middle of the short squeeze. Even if you post the collateral, they could still take your shares away that you borrowed.
well, how's the economy down in Miami?
Yeah, no, I think the economy is great here. Everything is pretty much open. People are working, so it's pretty good.
All right, the main takeaways are that there was a decline in the last half hour in the market. That's very bullish. There was a new high that was set at 330, and then it closed basically unchanged. There should be some real fireworks tomorrow because everybody will be expecting lassitude, expecting the half-hour prices to be within a point or two of each other the way they are today. And tomorrow there should be some real volatility. So
Right.
I think that the idea of trying to sell a small rise and buy a small decline, which should be very deleterious tomorrow. All right. Well,
tomorrow, I'd like to ask you about Bitcoin. We haven't talked about Bitcoin for a while, so let's talk about that tomorrow.
we should ask my brother, who's been buying Bitcoin since it was $5 a Bitcoin. So he's had quite a run.
Well, maybe you can let us know tomorrow if he's ever planning on selling, or is he gonna hold it forever?
I think more to the point, it's had a positive impact on gold. Gold seems to be following it every day now. And eventually, gold has been a store of value and it's kept up. You could buy a suit with 1 ounce of gold for the last 2,000 years. And eventually there's going to be a lot of inflation. I noticed that bonds were down a point today. It's amazing.
So, I guess you're not a fan of MMT, modern monetary theory, that is so popular lately?
No, I'm a fan of Miesian inflation. He says that eventually all the borrowing, all the printing of money will lead to runaway inflation. But more important than that, I think it's very deleterious to be bailing out all the companies that are doing badly. That we should be, the economy is supposed to work by providing capital to the companies that are making the highest return. And now we're providing capital to those that are making the lowest return. And people are getting, they're adjusting to the power of government. And that, I think, has a very long-term negative consequence. So when they have this bailout, I agree with you, it will be very bearish. But
well, many companies in general are not making any profit at all. They go public and they have not even potential of making profit, like Dash, for example, the delivery company that just went public. I don't think they will ever make any money because they have just too much competition and the costs are too high. And after Corona passes, people will continue going out. So, and many examples of companies like that go public, and they could go for 5, 10, 20 years and never make any money. So is that the new paradigm where profits don't matter anymore and only what matters is the rate of growth? As long as you're growing, how much money you're making doesn't matter. Victor, what do you think about that?
I think that's a fallacy. The reason that people buy stocks is because they expected eventually to earn a lot of money. And if you bought all the internet companies in 2000, you would have probably ended up doing twice as well as the stock market. I think for the last 15 years, every year, the NASDAQ has performed better than the S&P. And all these stocks that seem to have such a high price relative to the earnings are there because they expect the earnings to be there in 5 and 10 years in the future. I once had a very major interest in Navtech, and it was, they provide all the maps that are used by Google and by cars to find the correct route. And they had lost money for about 15 years in a row when they went public. And all the cable companies had lost money, but eventually the market tends to be correct. And I'd say that the companies that are showing a deficit are probably more attractive than the companies that are showing a profit. The companies that are the value companies make a return that's consistent with the rate of interest. And it's the growth companies that eventually provide the return for the market. So,
well, Tesla being a prime example, it hasn't made any money probably ever, yet it's Tesla.
Yeah, they're expecting it to make a lot of money. And
right, it's been over 5, 7 years that they haven't made any money outside of credits from the government. So it's back to your point about incentives again.
It's up 7-fold this year, and
right.
Plus, investors value it based upon the earnings over the next 20 years. And they're expecting that in the next 20 years, eventually it will be earning a price that will justify, a level that will justify its current price, which they expect to be $2,500 in a year. So again, the idea of shorting the companies that seem to have the highest PE, I think is a very losing one. Has to be tested. It has been tested. And the companies that show the highest appreciation in the year tend to continue.
Right.
So, okay, until tomorrow, thank you very much.
Thank you. Bye-bye.